Hi, this video is very important for all CMA and ACCA students. In this video, I'm going to talk about sales and market variances. Hi, I'm the commerce specialist. Welcome to my channel where you'll find videos covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So let's talk about sales variances first. Basically, sales variances are very simple, but it depends under what circumstances you are supposed to calculate sales variances. What I mean is what data is given to you. In a simplest form, when we're talking about sales variances, there are only two variances: sales price variance, sales volume variance. Let's look at their formula. So if we are talking about sales price variance, the formula is very simple: standard price minus actual price into actual quantity, or you can write actual volume. So let's assume standard price, which the company has decided, which is the budgeted price, that they will sell one unit for $100. But actually they ended up selling one unit for 90. And in reality they sold 10,000 units. Now here we need to understand, because sales price variance, sales is a revenue item. So we wanted to sell for 100, but we sold for 90. That means there will be decline in revenue. So 10 minus 90, though it is a positive 10, and when we multiply it by 10,000, the final answer would be 100,000. But this would be considered as an adverse variance. Why adverse variance? Because we wanted to sell it for 100, but we sold it for less. So revenue will be $10 less for 10,000 units. This is sales price variance. Another sales variance is calculated sales volume variance, or you can call it sales quantity variance. So the formula is standard quantity minus actual quantity into standard price. Now standard quantity is the quantity we wanted to sell. Let's say we wanted to sell 9,000 units, but in reality we ended up selling 10,000 units. Standard selling price 100. So if you look at 9,000 minus 10,000, though we have minus 1,000, and when we multiply by 100, we get minus 100,000. Still, this will be a favorable variance. Why this will be a favorable variance? Because we budgeted that we'll sell 9,000 units, but in reality we sold 10,000 units. And when it comes to sales, if you sell more than the budgeted quantity, it is always considered something very positive. Because you see, we are talking about revenue. If your actual revenue is more than your budgeted revenue, it's considered something good. So here if you look at, let's say you got a target of selling 9,000 units, but in reality you sold 10,000. So you would be rewarded if you're a sales manager. So in a simplest form, we have sales price variance, standard price minus actual price into actual quantity, and sales volume variance, also called sales quantity variance, standard quantity into actual quantity into selling price. Here we need to understand that in case of selling price, if the actual price is more, this is standard price. If the actual price is more, only then we will have favorable variance, irrespective of the quantity. But when we're talking about sales volume variance, if the actual volume is more, then there is favorable variance. If the actual quantity or actual volume is less than what you decided, this is the budgeted amount. If your actual is less, then you will end up having an adverse variance. Now I will take you to a different dimension of sales variances, where we are taking into consideration static budget, flex budget, and actual budget. Now on flex budgeting, I have already created a video. Make sure you watch that video to understand more on how flex budgets are prepared. Here my focus is towards the sales variances. So I have some amounts here. This is a static budget, the first one. If you look at, this budget has been prepared for 24,000 units. So if you are selling 24,000 units, your sales is 2.880 million. Obviously, when you divide this by 24,000, you will get the selling price. Your variable costs are given if you're selling 24,000 units. Contribution if you're selling 24,000 units. Fixed cost for 24,000 units, and operating income if you are making and selling 24,000 units. In reality, you sold only 20 units. So this happened to be your sales, your variable cost. your contribution, your fixed cost, and your actual operating profit. This static budget is for 24,000 units and this actual results are for 20,000 units. Generally, we do not compare the static and the actual ones. What we do is, looking at the static budget, which is this, we try to make a flexible budget, which means if we sell 24,000 units, sales is this much. What if we sell 20,000 units? What would the sales be? Or had we sold 20,000 units, what the sales would have been? So this is the flex budget. What we do is 2.8 million divided by 24,000, we get the selling price that we multiply by 20,000 units. That's how we got 2.4 million. Likewise, the variable cost, we pick the variable cost from here, divide this by 24, we get variable cost for 1 unit, then we multiply it by 20,000 units, we get this variable cost. Similarly, we arrive at all these amounts. Fixed cost, obviously, we understand cost behavior. If you're selling more units, generally fixed cost does not change. So I'm taking fixed cost the same. So we got the flex budget. In order to calculate variances, it is advisable that we compare flexed with the actual. This point I have covered in detail in my video on flex budget. Please make sure you watch that video. Now there is a possibility, if you have these three information, static, flex and actual, you may be asked to calculate 3 different types of variances. Number 1 is total static budget variance. So in order to calculate total static budget variance, what you do is you compare these two. This will give you total static budget variance. So if you find the difference between 216,000 and 29,800, you get 186,200. And obviously, as per original budget, you were supposed to sell 24,000 units and you were expecting to make a profit of 216,000. In reality, you only sold 20,000 units and you're making this much profit. So obviously, this would be an adverse variance. Total static budget variance is the difference between the static budget and the actual results. And you can calculate it for line items. These are called line items. Sales, variable cost, contribution, fixed cost, operating income. These are called line items. And you can calculate total static budget variance for all the line items if you want. For example, sales, 2.8 million minus 2.5. You will get total static budget variance for sales. Likewise for variable cost, contribution, so on and so forth. The other variance you may be asked in examination is total flexible budget variance. Now for total flexible budget variance, what you do is you compare the flexed amount with the actual. Means I'm talking about you're comparing these two. So 88,000 minus 29,800 will give you 58,200, and obviously for 20,000 units, profit should have been 88,000, but in reality it is just 29,800. So obviously this would be an adverse variance or unfavorable variance. The other variance you may be asked to calculate is sales volume variance. For sales volume variance, what you do is you compare the static and the flexed amount. Means 216,000 minus 88. This will give you 128,000. This again is an adverse variance. Why? Because we are talking about total sales volume variance. So if you look at, because of you plan to sell 24,000 units, but you only sold 20,000 units, because of the difference of 4,000 units, what is the profit which you did not make? You were aiming at profit of 216, but you ended up making 88,000. So this is the profit which you lost because of selling 4,000 less units. Now what else can be asked? Up till now we were talking about a single product. What if you are selling multiple products? So if you are selling multiple products, sales variances could be a little different. Let's have a look. Here we are assuming that we are selling 2 products A and B. Static budget is given. Static means the original budget. Standard selling price for product A is 115 per unit. For product B is 125 per unit. Standard quantity, or SM means standard mix. Now here we need to understand standard mix. Standard mix is what was the original proportion, the mix, the quantities we intended to sell. We intended to sell 12,000 units of A and 12,000 units of B. So as a result, had we sold 12,000 of A and 12,000 of B at 115 and 125 selling price respectively, our total revenues would have been this much, and this would have been the total revenue for both the products. We are also given flexible budget, and this is for the actual quantities sold, which is the actual mix, if you could see here. In reality, we only sold 12,000 units of A and 7,500 units of B, keeping the standard price constant. So if we charge the same price and had we sold different quantities, what the revenue would have been and what is the total revenue? That is called flex budget. We are using the same standard selling price but different quantity. The actual mix, the proportion, the combination is different. So the total revenue is this and the total quantity actually sold is this much. Now for multiple products, we have two sales variances, sales quantity variance and sales mix variance. So before we calculate these two, we have to calculate something called VASPAM. VASPAM is weighted average standard price. I'm writing here, weighted average standard price for standard mix. See, these are standard price and this is standard quantity or standard mix, right? So obviously this standard price into standard quantity, we get this. So this total sales multiplied by 24,000 will give me VASPism, which is standard price into standard mix. How to calculate? Just divide total revenue by 24,000. This is all static budget amounts. So 2,880,000 divide by 24,000 units, which will give you $120. So here we can simply calculate sales quantity variance, which is equal to standard quantity minus actual quantity into VASPism. So if you look at standard quantity, these many units we wanted to sell, 24,000 units in total we wanted to sell. Actual quantity, actually we sold 20,000 units. Now this is the determining factor. We wanted to sell 24,000 but we sold less. Don't forget, we are talking about sales variances. It's a revenue item. We wanted to sell 24 but we sold less. The answer has to be unfavorable, adverse. Multiply by weighted average standard price for standard mix. So this is weighted average standard price for standard mix. Okay, so you multiply it by 120. So obviously 24 minus 20 is 4,000. 4,000 into 120 will finally give you 480,000 adverse variance. Please do not involve mathematics here because 24 minus 20 is positive 4. We are not looking at mathematics plus or minus. We are looking at the concept. We ended up selling less units. We wanted to sell this much, but we sold less. Because it's a revenue variance, selling less is not considered good. It is adverse. That's why we're calling it adverse. It is unfavorable. The other variance is called sales mix variance. So the formula is VASPism minus VASPAM into actual quantity. Now VASPism we already have, which is 120. Actual quantity we already have 20,000 units. Now what is VASPAM? VASPAM, if you notice, this SP is standard price and AM is actual mix. So this is your standard price and this is your actual mix. So now you take this revenue, the flexible budget revenue, divide by the actual quantity. So you will get VASPAM, WASPAM. This is standard price into actual mix. These are your standard price and this is the actual quantity, means actual mix. So 2,375,000 divided by 20,000. 2,375,000 divided by 20,000 units will give you 118.75. Same you will take here, minus 118.75. So now if you notice, your standard price, average standard price was supposed to be 120, but you charged customers on an average 118. Again, if you're charging less price, it's considered unfavorable. So the difference of this multiplied by 20,000 will give you a final amount of 25,000, which is again adverse, and you can write it unfavorable if you want to, unfavorable or adverse. So guys, these were the two variances of sales if you have multiple products: sales quantity variance and sales mix variance. Important to understand how we calculate VASPism. VASPism, understand this: standard price into standard mix. Standard price into standard mix, which is the standard quantity. So divide the sales by this, you will get VASPism. But when you're talking about VASPAM, which is standard price into actual mix. So you have standard price here, the actual quantity, actual mix is here. Divide the sales by this, you will get VASPAM. So VASPism minus VASPAM into actual quantity. Sometimes you're also asked to calculate variances which relates to the market. Now, market variances are categorized into two: market size variance and market share variance. Before I get into market size and market share variance, we need to understand what is market size and what is market share. Have a look at this. When we talk about market size, so let's say in year 2024, total cars sold in year 2024 in a given country is 1 million. This is called market size, which means the number of cars sold in 2024 in a given year. Now this 1 million units, 1 million car represents all the mix like Toyota, Honda and others. When we talk about market share, for example, total number of cars sold is 1 million, which includes different brands of car, different makes like Toyota, Honda, BMW, so on and so forth. And if you're trying to find out market share of Toyota, so let's say in this 1 million cars, which are of different brands, different makes, 100,000 cars were Toyotas. So this is all the cars sold, and this is Toyotas out of all the cars. If you multiply by 100, you get 10%, which means in the total sales, Toyota's market share is 10%. But when we talk about the market size, this is all the cars sold in a given year. This is the market size. How many Toyotas, how many Hondas sold? So if you take that as a percentage of the total, you'll get the market share. So now let's talk about the very first variance, which we called market size variance. Market size variance. The formula is expected market size in units minus actual market size in units multiply by expected market share, obviously this is in percentage, and the whole stuff is multiplied by VASPism, weighted average standard price for standard mix. But understand, sometimes instead of standard price, we also take standard contribution per unit. And you should know standard contribution per unit is calculated by standard price, that is standard selling price minus standard variable cost. So if you're trying to find out in terms of contribution, the variance, you take expected market size minus actual market size into expected market share. Now these two are in units, this is a percentage. Whatever you get, multiply by weighted average standard price for standard mix. If you want to calculate in terms of contribution, instead of standard price, take standard contribution per unit. And obviously, if you look at this, if your actual market size is higher and expected market size is less, actual is higher, you end up having a favorable variance. If your expected market size is higher but actual market size is less, you will end up having an adverse variance. Now let's discuss the market share variance. The formula is like this: expected market share, obviously it's in terms of percentage, minus actual market share in percentage into actual market size, obviously this will be in units, whole thing multiplied by same weighted average standard price for standard mix. So let's say expected market share is 50%, which is very high. Actual market share is 40%. So you'll have 10% here into actual market size. Let's say the market size is 900,000. So 10% of 900,000 will be 90,000. And this is in units. So 90,000 multiplied by weighted average standard price standard mix, and sometimes instead of standard price you can use standard contribution, and I don't need to tell you how to calculate contribution. So guys, these are all the possible variances for sales. I hope you have understood this. If you have any question relating to this, please leave it in the comment section. I will reply to you. Do let me know from which part of the world you're watching me. I really feel very happy to know where my supporters are. Now, if you're not yet subscribed to my channel, please subscribe. This is one way of showing that you value my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.